table. Now, I was just reading this. It's an interesting article by Adam over on the Forex Live, talking about how bond yields have peaked and there's no market more in tune with the Fed and inflation outlook. And he's suggesting that perhaps interest rates have peaked when the 10-year hit 3.5% on June 14, just before the FOMC, then sank back to 2.75% and has rallied a little bit since to 3.1. Comparing this to 2018, when the Fed was raising rates up until Christmas 2018, 2.5%, and the stock market tanked, as you can see here. Stock market tanked at that time, but the bonds had peaked 6 weeks before and peaked at 3.25%, and the Fed did an about face in January and started dropping rates. So the bond market tends to indicate the peak before stocks do, and you're not going to get a bottom in stocks until bonds have done that. So that was an interesting read, and looking at where bond prices are now, we can see the 10-year here it's peaked at 3.5 last. I think we're going to go and have another look at 3.5 again as we run into July 28th, when we've got the Fed meeting and a raise of 75 basis points in that meeting. So I'll look to see the US bond market rally into that and effectively create a double top, similar to what it did back in 2018, a double top across there, and then the market fell away as the US Fed don't have a meeting in August, so they'll likely raise rates again on July 28th and then not raise anymore, and maybe even in the September meeting be on hold or look to lower it, as we're seeing some inflation or deflationary pressures come into the market with the commodity market coming off. That's the energy market. We're seeing iron ore come off. Coke and Cola's up a little, but across here the commodity index certainly heading down, so perhaps the inflationary issues are starting to dissipate, and the rise in rates is already having that effect on the market. We're going to have a look at the soft commodities. The copper's off a little bit, indicating that risk of recession is still there. And into the soft commodities, a bit of a bounce across the board into the end of the last week. We're seeing corn and sugar, wheat, soybeans, all sort of pushing higher. A bit of a relief rally after a pretty strong drop in the months leading or weeks leading into that midweek turnaround last week. In the indices, have we seen a bottom? Well, certainly we're still getting lower highs, so I wouldn't suggest we have yet. Highly possible that it is. At the seeing the bottom there, that was the bear market, 20% retracement from the highs. That's entirely possible. I wouldn't get busy buying until we start seeing higher highs. We're seeing a higher low there, but if we get a higher high as well, then you've got one cycle, maybe two cycles to the upside, and we can get busy buying stocks. But until then, the play for me is still buying the US dollar on dips, and a bit of a turning around bar there. A high test bar as the market hit exhaustion on the RSI as well. I would expect the US dollar to maybe come back down to this level here before running again into the FOMC, and that would give the euro a retest of this neckline. Aussie back up to 70 cents, but perhaps, and looking for the pound to short the pound around the 121.50 level if it can get there. And the dollar yen, similar to the bonds, it will peak around the same time as the bonds, and it's looking like that. So we might get another little push higher It's been sort of stuck here sideways, but you're also getting this little wedge happening across here. So might break out of that and push a little higher before peaking and then falling. If we look back at 2018 time, that's the run into and the stock market sell-off, and strengthening again into the COVID period. Certainly pretty weak right now. So that's, for me, the play is again still buying US dollar on dips and or fading the majors when it hits a resistance level, and we'll look at stocks when the market finally puts in a higher high. That's it for today. Stay safe, and we'll catch you tomorrow.